Welcome to the GCV Weekly Briefing Podcast, where we break down the key financial and economic developments shaping the landscape for investors, businesses, and policymakers. I'm Matthew, and this week we're unpacking four major stories. From stubborn inflation and interest rate decisions, to what's happening with UK house prices, and the possibility of a dividend tax rise. There's a lot to cover, so let's get started. First up, inflation in the UK dipped slightly to 3.4% in May. Now at first glance, this does look like progress, but looking under the surface, pressures do still remain. Petrol prices and airfares dropped, helping lower the overall rate, but food prices went the other way. Annual food inflation jumped to 4.4%, a full percentage point up from April. This rise in food costs complicates the Bank of England's job. While core inflation, stripping out food, energy and alcohol, has dropped to 3.5%, there's still a lot of caution amongst policymakers. Now, some of this is seasonal. Airfares, for example, fell sharply by 20 percentage points, mainly because Easter landed earlier this year. Services inflation is still very high, though it cooled from 5.4% to 4.7%. Furniture and household goods climbed, while clothing and footwear prices continued their slide, down 0.3% year on year. It's also worth noting that the ONS admitted to overestimating April's inflation figure, due to a weighting issue with car tax. Now, it's a small error, but it's a reminder that economic data isn't always as precise as we would like it to be. Still, the trend is clear. Prices are still moving up. Meanwhile, wages are slowing, unemployment is creeping up, and the economy in fact shrank in April. Chancellor Rachel Reeves is already pushing the bank to cut rates faster, arguing that high borrowing costs are weighing households down, but economists say it's clearly not that simple. As Ruth Gregory at Capital Economics explained, the third consecutive food price inflation rise will be a bit of a blow for the bank, perhaps a sign that firms are passing on more of April's rise in national insurance contributions into their selling prices. That leads neatly into our next story, the Bank of England's latest rate decision. The bank held interest rates at a steady 4.25%. No change, but no strong signal of when they'll begin cutting again. Governor Andrew Bailey highlighted rising prices and a fragile labour market as the key reasons for standing still, and global events are making it harder to act decisively. The ongoing conflict in the Middle East, especially between Israel and Iran, has pushed oil prices up nearly 25% since the bank's last meeting, now hovering at nearly $80 a barrel. That spike has knock-on effects, of course. Higher energy prices feed into inflation and reduce consumer spending power, especially in the UK, where households are still recovering from that cost of living squeeze over the past few years. There's also concern that renewed pressure on prices could lead to a fresh round of wage demands, keeping inflation stubbornly high. Rising costs of beef, cocoa, and coffee are still being watched very closely. The bank says rates will gradually come down, but there's no rush. Any wrong move could trigger a rebound in inflation. On the positive side, progress on trade deals might help to offset some of the pressure from US tariffs, and the bank's watching for signs whether the weaker labour market might start easing inflation further. But to quote the bank's own warning, external volatility can derail even the best laid out plans. Now to the housing market. UK house prices fell sharply in April, down 2.8% month on month, the biggest drop since 2021. The reason? Well, the end of a temporary stamp duty holiday. The average property price is now £265,000, and this pattern isn't new. We saw a similar dip in mid-2021 when the previous stamp duty break came to an end. Industry analysts aren't too worried at all. Nick Leeming at Jackson Stops called it a post-deadline lull, and Yopa CEO Verona Frankish described it as a brief market correction. What's actually happened is that buyers who missed the tax break have been renegotiating their offers, resulting in lower prices that aren't necessarily a sign of deep market weakness. And May brought a bit more optimism. New listings and completions were up. Sellers and buyers seem to be regaining confidence. Of course, high mortgage rates and hefty deposit requirements are still a barrier, especially for those first-time buyers. Analysts say we're more likely to see slow and steady growth rather than another crash. Mark of Benham & Reeves summed it up by saying any initial reduction in house prices as a result of stamp duty decline will have been short-lived. Finally, let's look at some growing concerns around the potential for a dividend tax hike. Chancellor Rachel Reeves is reportedly considering to raise as much as $20 billion in the next autumn budget. An option under review is increasing the top dividend tax rate, or scrapping the £500 annual allowance altogether. That could raise around $325 million, but wealth advisors, including those at St James's Place, say it might not work as planned. The worry is that individuals would simply change how they take income, favouring salaries over dividends, and seek more tax-efficient investing methods. Recent increases in national insurance have already made firms cautious, reducing investment and hiring plans. So, what are we seeing this week? Well, a stubborn economic picture. Inflation is proving harder to shift, interest rate cuts remain distant, and property prices are reacting to short-term policy changes. On top of that, new potential tax proposals are already raising some red flags. It's a cautious environment, and for investors, reinforcing diversification strategies might prove worthwhile. That's all for today's update. Thank you for listening.